This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
I want to take you back in time. October 2014. I have no memory of what I was doing then, but through the magic of this podcast, I can find out. And back to back, I had two guests in October 2014, two market guests, two trading pros who I want to bring forward to today. Why? Because like most of the stuff I do in this podcast, it's timeless. I'm not trying to be the person that has some opinion about the 1 second that's going on right now that's not usable at some other point in time. I have tried like my level-headed best since the inception of this podcast to make it timeless. So when I want to reach back and I want to do a best of, and I want to let some people that are new to the podcast in 2020 get a feel for some of those brilliant minds that have been on in the past, I know, because of the way that I've done this show, I can reach back and bring great insights completely appropriate for right now. My guests today, Toby Crable and Alex Gracerman. Toby, the famed short-term trader. You've probably seen his book, quite famous. Actually, it's quite expensive these days if you want to find it on Amazon. And Alex Gracerman, who got his start with Larry Hite, a long-term type trader, a trend-following guy. Don't think about their differences, though. Think about what makes them the same. The drive, the attitude, the stick-with-it spirit. That's what's important. That's what you take away. So let's jump right into a little bit of my timeless archives and make those two episodes, Toby Crable, Alex Gracerman, into something right now, current, useful for you.
I first reached out to my guest today in 2005. It just struck me, and we talk about it in our conversation. 9 years ago. Damn, time flies. Toby Crable is my guest today. Crable Capital Management. Short-term systematic trader, quant. Very different than most of my world. Now, a lot of commonalities. Price action driven, systems, models, risk management. But Toby is working on a whole different time frame, turning his portfolio over typically in less than a day. But I still remember our first meeting. It was a great conversation. And what struck me about Toby was his philosophical nature. The competitive sports side, a former pro tennis player, but that philosophical nature, and then executing it in the systematic trading world. I thought it was such a unique story, then and today. I hope you enjoyed this conversation. Toby, Mike Covel.
Hi, Mike. How are you?
Man, it's been a long time. I think it could be 9 years since we spoke.
I think that's right. I think it was in the Virgin Islands, right?
Yeah, I was like, wow, where's time go? That's really scary.
It's a bit frightening.
Right. I just hope they figure out this life extension soon before we leave. So.
Yeah. Interview Ray Kurzweil. I think he's after it. So.
Yeah. So how's it going?
It's okay. I keep working at it and improving a little bit incrementally, and those little gains help. So that the firm's going well, my family's good, and we've fully moved out from Wisconsin, and it's a good life. Playing a lot of tennis, and there's a lot of good things happening here.
Let me jump into the setup of tennis, but first I want to describe a few big picture points. I want to drive right into what you just mentioned. So the head of Covel Capital, over $1 billion assets under management. Since 1992, your track record starts, but not an overnight success story. And I just checked on Amazon today to look at your book, Day Trading with Short-Term Price Patterns, priced at $981 for a new copy.
But a little low.
So, but here's where I want to go though. Before all of this, pro tennis player, I think you got as high as 280, or as low, I should say, 280 in the world. Talk to me about though that experience of being such a competitive tennis player. The 8 hours a day for years practicing. Is there a direct translation to the competitive drive that you have in the asset management field, the fund management field?
I think a direct translation, actually. I mean, I refer to it all the time. It's an analogy for what I'm doing in my business and the way I approach things. So, especially in those early years of the track record, but it can be a good training ground if you take away from it the idea that we can always get better and we can improve at what we're doing, and the one thing that's very clear is that there's losing days, and there's losing trades, and there's losing tennis matches, and how that's handled and what you take away from it is the most important thing. So that's I think for me is the key to longevity, and the solace that I haven't always done that very well. I mean, in tennis, I think I stopped a little early. I had looking at the record, I had a lot more potential than I gave myself credit for. So one of the things I take away from that first career is that I'm not going to quit. So that's why. I mean, there's been some tough times in these markets and in my own business, and I just don't. First of all, I don't want to destroy anything that I have by having too big a drawdown. So we're very conservative with risk, and I think that permeates the firm. And then secondly, when you're there to fight for another day, you don't let yourself get overwhelmed by the tough times, the losses, the day-to-day grind of it. You try to elevate a little bit and keep my head about me when it comes to that.
I'm guessing from a tennis analogy, if we're going to stay there for just a moment, you would probably prefer the consistency of a track record. If I pull up Wikipedia and I look at Federer versus a Nadal. Nadal is fantastic, but he doesn't have, best that I can tell, the consistency is Federer's in a completely different league.
Yeah, I truly do admire, of course, both players, but Federer's it's incredible talent. But the way he plays, there's a conservation there of energy, I think, that will allow him to play, I think probably we'll see a lot longer than a lot of players. And there were others like that in the history of the game. I mean, Ken Rosewall played into his 40s and did very, very well. It doesn't happen as much anymore, but, I can think of Pancho Gonzalez was in his 40s when I think he did very well at Wimbledon one year. So, I mean, if you're, I don't know if it's pacing yourself, but Nadal's passion is fantastic. You have to love the intensity that he brings to the game, and there's really something really important about that when you see it. But yeah, I mean, when I think of my careers, especially this one, I'm thinking lifelong. This is something that I really enjoy, and I'm just fascinated by markets and price movement and how to quantify that. It's my science. It's what I do. And there's hardly, I mean, you can train in other sciences and that'll help, but it's you got to really get in there and work with the market data and use your imagination. So yeah, this is a lifelong pursuit, Mike, and I think that I don't think I'd have it any other way. I'm not going anywhere.
Let me drive into this. So I want to break apart some trading aspects and details of how you approach the markets philosophically, et cetera. But I know when we talked years ago, you really thought that your space, and we had a nice long conversation comparing your style of trading to trend following, some of the quant trend following. And there were some commonalities, but your time frame was very different. And you painted a picture that you were in a pretty unique space, that you were very humble about it, but you were saying it was very difficult to compete with your strategies. Whereas there definitely are, many more trend following traders out there, and still to this day. So I'm curious, do you still feel like you have this unique space, your firm, and its multiple strategies?
I think so. In the money management world, handling client capital, I think it is unique because most of the shops I think our evolution is we're moving shorter, and our holding periods are tending to be shorter. So with that lends itself to there's only so much in the way of assets that you can manage, and there's a demand for it if you're good at it. So you have to be careful. And what happens is I think there's some very good proprietary firms that have evolved into relatively short-term trading like us, or shorter. And the high-frequency firms are certainly an example of this. I think that they're primarily or almost exclusively high-frequency are prop firms. So they're using their own money and investing that, and instead of trading client capital. And it's understandable because of the capacity constraints that exist in the short-term area. But yes, it is unique because it's certainly in the money management field, there aren't a lot of us. What we do is we're trading primarily liquid instruments. We're a liquid product for clients. We trade frequently. We're less than 1 day, and our holding period, on average, is a lot of turnover in the portfolio. It costs a lot. It costs a lot to run the business. There's huge challenges in the execution area. So we really, it's not an area that I think is just not that because of how it's prohibitive with the cost. It's just an expensive proposition. So there's not a lot of people that are going into this. So, but I came by it honestly. I worked with a floor trader in the early '80s. And we had a joint account. In his account, he paid no commission. So I was led by the nose to be trading and to take profits intraday. That just stuck with me over the years. That's just what appealed to me after doing that. You're kind of hooked. So yeah, it is a unique area in the money management field for sure. There's plenty of prop firms though that do this. And those are our true competitors, I think, when we think of where we're at on the planet. It's those prop firms that really stand out to us.
We spoke before. It was multiple diversified systems, applying them systematically across multiple different time frames. Where are you in your total number of systems these days?
Yeah, you can talk about the systems individually, and there's several thousand in the portfolio. Or you can talk about the ideas, which are broader conceptual frameworks that we work with. So, for instance, in my area of the portfolio that I oversee the strategies in particular, I'd say there's probably 25 conceptual frameworks that I'm working with there. And I think the rest of the portfolio managers in the firm think in the same way. So they have a broad conceptual framework, and then they apply it in particular with a strategy, and may even vary it slightly in the different markets because markets are different. The universals apply throughout all markets, but there are particular aspects of each market that you should probably take into account. So what I like to say is that the markets are are the same in principle, but at the same time, they're different. So we're dealing with two sort of different formulations of what markets are. Do you optimize for each market? Well, not heavily, but yeah, there are variations for each market. And that may count as an individual strategy, you see. So that's probably why the number is as high as it is.
You would like your models working across all markets, though. I mean, if that model works, you want it working at all markets.
And when you're doing the testing, you want to see you want to see it apply universally, I think, across all markets without much variation. Actually, without any variation. So that's step one. After that, you may go in there and take a closer look at it. Because one example clearly is that there's a lunch hour in Asia in Hang Seng. I think it's Hang Seng. Yeah, Hang Seng takes off for like an hour and they go to lunch. If you're going to trade that, you have to account for it. It's almost like a new opening, the second round. When they come back from lunch, it's starting fresh. Back in the day when I wrote Opening Range Breakout, I don't know if I took that into account. It may be something to take into account. Have 2 openings a day in the Hang Seng market. Well, that's a unique sort of construct. You have to take those kind of things into consideration. But the general principles apply. That's certainly what I've seen and tried to adhere to, is that because that's a more robust framework than when you're building these portfolios. There's not any clear-cut statistics that tell you what it is you're supposed to be doing with a strategy. There's just not that much insight in the stats. But what you do know is that if you can find something, a widget that can be applied in sort of a universal, general way, then you have something that's really, really powerful.
The phraseology you'd used years ago with me was a kind of an assembly line thinking is what you were, that automation and being able to apply it religiously.
Yeah, that's it's an appealing way of looking at it. Sometimes it really. I think what it does is it keeps you honest when you're applying these strategies. So that's very important.
So Toby, when you're talking with clients, or you get the random elevator pitch, but you probably don't get too many of those, or you have to give the random elevator pitch, people want to know, where did the profits come from for Covel Capital Management? So, you've got counter trend strategies, you have momentum style strategies, you probably have others that I don't know about, but where philosophically do you see those profits coming from? Why are you able to extricate those profits from these liquid markets, liquid futures markets, et cetera?
Well, I think when we're successful, what we're trying to do is find areas where it's very difficult for participants to act, places where there's market price action that aren't comfortable places for a human being to trade in the way that we're trading. And those seem to be the most profitable. And if you're a discretionary trader and you're doing that, either you're rewiring your sort of innate psychological disposition in order to do that sort of thing, or the fast track to this is to quantify it and then just let the machine do the work. But over time, a discretionary trader, going against his nature, fear, greed, it will wear down because it's traumatic in a way. And that's where the automation is a real help. You need in order to get an edge, you need to do something that essentially nobody else can feel comfortable doing. I mean, there's got to be some people, but you may be the first, or you're very early on. So the recognition of that requires a little getting ahead of it a little bit. Seeing the market work itself into a position where it's vulnerable to sort of weak thinking that can take place because we are vulnerable as humans. That may be too philosophical, but the problem, you don't want crowded trades. You want to be there when it's very difficult for other traders to operate. And that's sort of the wonder of systematic trading, I think. It's a real benefit. That said, we tend to try to find the times when it's right to go against price action. And then, as my early work would suggest, I also was looking for times when the market is ready to move directionally in any given, day, and isolate those environments. That's an interesting area of work. The markets are different at different points, and that has to be taken into account. You have to. It's almost as if there's two separate, but there's more than that. There's many different environments, but traditionally our portfolios have been separated into at least two primary areas of mean reversion and momentum. It's our job to find out when it's right to do that.
You've not strayed from price action. I mean, your firm is price action at its foundation.
Yeah, and everything else that kind of goes along with that. I mean, volatility and volume, and there's other factors I think that are primary in that. But price action is a starting point. Price is a starting point. It makes it easy too. I mean, you get a lot from just looking at price alone. There's a lot there.
Talk about volatility since you bring it up, and I think everybody knows in the last month or two we've seen some significant volatility across the board, and volatility is something, and a little bit of chaos, a little bit of markets starting to have that enthusiasm. That's not something. That's not a negative for your firm.
Well, it depends. There's winning and losing volatility. We prefer the winning volatility. At this point, what we have seen is this, and then it's changed a lot of things in our firm. That up till a few months ago, the volatility was at record lows in most of the markets. Foreign exchange market, the interest rate markets, even the stock market as it was rallying was on relatively narrow trade day to day. And so the volatility, the VIX was at a very, very low level until just recently. But with the foreign exchange markets perking up in the last couple of months, literally in most of the foreign exchange markets, euro currency, dollar yen, you had the lowest volatility range that I've seen since I've started trading, and those were relatively good markets for us to trade in the past. If the volatility gets too low, there's no movement. There's nothing to really take advantage of. You need price movement. What's happened though is all of the markets, starting with foreign exchange a couple months ago, have changed, and the volatility has increased at least doubled, which is a welcome to what we need and for profitability. We need price movement. Now, the other thing, of course, we need is volume. And of concern is what happened in the last week or so with a lot of the markets when you had these very large price moves. The volume dried up significantly. And we haven't really seen that. That's a new phenomenon. It's sort of this early in a cycle of volatility. This is sort of a unique circumstance, which leaves a question mark for me as we go forward in the thinking that we're doing about allocations and the kind of risk that we may have in the market. So that's another story. But the volatility has increased. It took a long time. I don't think this is going away. As markets contract like they did for as long a period as they did, it's my opinion that the volatility cycle is on the rise rather than declining in most markets. So something's up, in my opinion. Economically, I don't know what that is. I do suspect that with the amount of intervention that's taken place in the markets over the years by some of the governments that the U.S. in particular, it's created a circumstance that can end up being very volatile, in my opinion.
Let me interject real quick there, because I think this is something central to your firm, and we talked about this when we first spoke, is the idea of shocks. And, when these volatile situations start, we can think back to the summer of '07. It was almost foreshadowed what came into '08. Now, of course, I'm not trying to make a prediction or anything. I'm just talking. But the idea of shocks, rubber band snaps, this is something you think about all the time. You're prepared for it. And you knew as a young man, and you saw this happen to other people, you did not want you didn't want to risk your career on price shocks.
Yeah, that's the truth. Well, we still have occasional bumps in the portfolio that certainly cause some sleepless nights. I mean, but look, I mean, the clients have a certain appetite for drawdowns, and if you're within the range that you propose, and if you can adhere to that, you're in good shape. You're doing what you say you're going to do, and that's very, very important when you're endearing trust in a program like ours. So, but yeah, price. I think we could say just in this last week we've had something of a price shock. Every time you see those, you understand where your weaknesses are thoroughly. So that's an area of it. It's a learning. If you can continue trading through that and you're okay, you haven't had a huge drawdown or, hurt your clients very badly, you've learned something. And there are things that you can put into place that will protect you further from these kind of things and these kind of events. And then, of course, you try to think ahead at what can create real problems for the portfolio. But it takes a really thorough knowledge of what's in there and how the portfolios evolve. And there's a lot of production going on in our company, a lot of strategy development, and you have to stay on top of that and really understand what it is that people are implementing in the portfolio, and so to truly understand your risk. But that is it. Look, if I'm building a 50-year track record, and I'm almost halfway there on this, which is a goal of mine, you have to be able to get through those price shocks. Those are the things that are lurking out there that can thoroughly put you out of business. And you're right. I have seen it before. It could be terrifying.
You started your career as a guy with higher drawdowns, much higher drawdowns.
Mm-hmm.
So you've changed that. I mean, like a complete opposite side of the coin. I mean, you've gone from high drawdown to, I think I was looking today, between a max of, let's say, 15 to 16% on your big portfolio.
Yeah, and it's been a long time since we've seen that. That's a pretty big drawdown. I think that would be a big drawdown now. So, hopefully our risk-adjusted return is improving. But when I was trading at the beginning, I wasn't thinking about portfolio management, and I wasn't really tuned into what a client would want from a portfolio. So risk-adjusted return has become the primary benchmark measurement for our firm. So certainly we do want to have a consistent return, but a decent return, but we also want to do it in a way that, in a less chaotic way than, say, the S&P, and its long only position in the S&P. We would think that we would be far, far better than that. Our drawdown should be less, and our return should be higher, relatively speaking, than a lot of or any instruments out there. So we really want to be at the top of the risk-adjusted group in the hedge fund world.
I think you told me years ago it was, and you might be less today, but 0.02% risk per trade.
Yeah, I think it is less, actually, because of the more strategies you have, the less you allocate to each one. But that's part of the risk reduction in itself. There's diversification and low correlation between strategies, and the more you can bring on that are truly not correlated, it seems like the better.
I'd love to pick your brain just for a second and pretend this is like an audience question. So the trader out there, the would-be investor, and they love their one market. Perhaps they only fixate on one market, perhaps a currency or perhaps just one equity index. And then when they start to trade, they put these huge amounts of risk on. Maybe they could get 5, 10, 15%, perhaps more into this one market of their net worth. Why don't you talk about, I mean, you've been testing systems and looking at these things for decades. Just give the big picture out of the gate, why that's such a bad thing to do, to be fixated on the one market and to be extending yourself risk-wise. I mean, everyone should know instinctively, if you start risking that amount, you can blow yourself out. A couple losing trades and you're gone. I mean, capital's not unlimited.
Well, there's the allure of the profit too on the other side of that. So it can be quite appealing. Visions of change of life and quality of life if you can hit it on that trade. That's a problem. There's a gambling element, gambling mentality that's leading that. But I think this is part of the evolution of any trader. When I started out, I traded. You trade one market with one strategy, if that. You have a partial strategy, undeveloped. So, but as I moved along, what I've done is I've broadened out that and tried to diversify through different markets and strategies, and we're still doing it. And I think we're trading 300 markets now, which is much more than I think when we last talked. That's 300 futures markets and foreign exchange. So, equities presents a whole area of diversification if you do it right for us. For the beginning trader, though, I mean, if you can imagine a discretionary new trader, he doesn't have the knowledge base, he doesn't understand a lot of different strategies. He starts with one strategy. And I heard a quote from Richard Dennis. I think it was in one of the Market Wizards books, that at the beginning of your career, you should be trading the smallest with the least amount of capital on the line, because that's when your knowledge level is the lowest. And as you increase your knowledge base, you can increase your allocation. I think that pretty much says it all. So to a new trader, it should be a learning experiment at the outset. And if you're experimenting, you don't do it with a large amount of your capital. You do it with a very small amount, just maybe represented, or you don't do it with any capital. You just paper trade. But you evolve into a more complex trader if you can stay. Caveat on this is if you can stay in the game to learn. So you don't want to damage yourself. There's a lot of people who just drop by the wayside because they just cannot handle the loss if it's too big. Those traumatizing losses can take you out of the game. And if you're not in the game, you can't learn. So you want to stay in. You want to stay in the game. You do not want to risk so much that it just totally traumatizes you.
Was there a moment in your trading career where you felt like, wow, I'm at the point where I'm at the cliff and this could go drastically wrong? Or did you shift gears completely at some point in time and say, I'm just walking away from, we talked about having steeper drawdowns when you were younger. Is there any kind of moment that you could think back to, that kind of a revelation where you just said, wow, okay, I now know the direction. I see the space where I should be?
I think that when I went and worked Victor Niederhofer's shop, it was very, very clear to me. It was a sort of an integrating moment for me because I could see the research platform that was the best I'd ever seen, bar none, and it was a great team that was working there, and he had hired very, very well, and I was just happier than could be to be working there with someone like Victor. Now, Victor has different risk parameters on his trade. That's another story. But as far as a researcher and a market philosopher, I've never seen anything like Victor Niederhofer. He's an amazing man. And the fellows that work there, a lot of them I work with now. In fact, in my firm, we have 6 or 7 gentlemen that I had met back in the early 90s when I worked there. But whatever the 10 or 12 years, when I started in 1980 around the floors of the exchange, when I got to Victor's 12 years later, I had a pool of market knowledge that I'd kind of developed the hard way, and when I brought it into Victor's, it sort of came together for me. I felt confident that I could make something happen in the field. It wasn't that I wasn't profitable previously in the 80s, but it wasn't as consistent as I would have liked.
Might be a good time to interject just as a kind of a side note. And I know this a little bit about Victor's background too, enjoying the philosophy of objectivism. And I believe you do as well. Would you mind commenting on how that has affected your business life, your life in general, your entrepreneurial life?
Well, in the 80s, I think when I started trading, I just got off the tennis circuit. I played in Europe for a few years, played team tennis there. And my philosophy, my view of life was a little bit different, and I didn't really, objectivism, I came across what Atlas Shrugged in 1986 and read that, loved it. What it did for me was, and this is the marvelous thing about Rand's work, is it provides a very clear-cut moral code. In fact, the only one that I've really ever seen that supports what we do, capitalist behavior, the capitalist system. And so for an entrepreneur like myself, I really felt it was essential looking back on it, it was essential to have incorporated that in my life. It changed my thinking. It justified my actions. Markets are very, when you're around the exchanges, you kind of look at your fellow trader, say some of the guys that came off the floor. These are some rough and tumble fellows that were around the Chicago exchanges, and I almost, there were times when I wondered whether this was really what my calling should be. In fact, a couple of times in the 80s, I went and interviewed for jobs as a tennis pro, and thank God they didn't hire me because I may have been doing that. Of course, I would have found out quickly enough that probably wasn't what I wanted to do after all. When I ran across Ayn Rand's work, it was an integrating moment for me also, and it led me to Victor. Now, Victor has variations on his own position philosophically, and we all have our different views of things. Essentially, he was a free market thinker, and we met because of that, and plus he was a racket guy, and he liked tennis players. So that I went out and played tennis with him quite a bit at the beginning. It was an entry, along with my book. It was an entry into the Victor Niederhofer's world. But those are huge, I think, very, very important moments for me. I can't say enough about it. It's still an important. You really can't justify, I don't think. It's very hard to. There's a lot of confusion, I think, philosophically, and look at the regulatory groups out there and the people clamoring the newest book on Flash Boys and the beatings that traders are taking at just about any level. And how do you combat that in any way without some sort of sound philosophical underpinning? And I think Rand's philosophy provides that. It's an excellent moral code, in my opinion. It's a sane moral code.
Let me add back just one little bit on Victor, and I think it's interesting that everyone can read the press accounts from the last 15 years and whatnot, and many of those ended up being negative. And of course, he runs a very popular site, and a lot of people contribute there. But I think what's interesting is how many notable traders cut their teeth there. I mean, his brother, for one, many others that you can name off. So it's really interesting how many people really gained a toehold and a foundation. You could argue that you guys in some ways were another version of Turtles, perhaps, just a completely different setup. But I mean, there's a lot of people that came from being around him to have great success.
Well, yeah, Richard Dennis, I think when he had his experiment on whether he could train traders out of, create traders out of nothing, he brought in the original turtles, and I think that was fascinating. The one commonality is that they're quantitative. Victor was running a business. He needed to hire people, and what happened is that it was a quantitative shop primarily. You learn the ropes when you went in there. You were you work with the master. He was a powerful intellect when you worked with him. He was a professorial. He was tough. But he was a real teacher. Now, the turtles are, I don't know. I don't know as much about that. But as far as the fanfare around them, I think some of those guys have done very, very well. They have a lot of volatility in their portfolios. But they are generally all quantitative, and that's the real similarity. And you can teach quantitative work. It's something that is transferable, I think. Developing a portfolio is a little tougher. I know Victor never really taught portfolio development. I think Richard Dennis may have more. They diversified through many, many markets right at the outset, and I think that was some of the portfolio work that I do started with his allocation concepts that I drew from the readings and some of the turtles that did talk about it. So there's basic allocation methods. It's a good starting point when you're allocating to a lot of different markets. But I'm lucky because I met a lot of these fellows. Monroe Trout was also came out of Niederhofer, which is probably of any of the graduates, he's the most successful. And we don't hear about him much anymore. He's theoretically retired, but he was brilliant and did a fantastic job of building a business.
Hold on. Theoretically retired.
Yeah, I don't know. I can't tell.
We'll leave it at that.
So anyway, he's a great example. But we have, like I said, we have 4 or 5 portfolio managers in our firm that all came out of Victor's, and some of the best, I think, other than Monroe or Roy. So it's rewarding. It's a great group to work with. It's a wonderful sort of intellectual environment that we have that I'm very comfortable with. When I first started, I was a little lonely. I missed the guys at Victor's because there was a camaraderie and a very interesting. It was an interesting group of guys, and luckily I've been able to bring them on as time has gone by.
Hey, Toby, you mentioned 300 futures contracts today, and I think since we've been talking some of the quant style at the longer time frame, trend following models, and some of the shorter term models. For example, some of the guys that you mentioned that you got to know from Victor Niederhofer's shop. Talk about I think there's another commonality there, which is the liquid futures markets. So many of the traders that everyone reads about and all the books, the Market Wizards books, futures trading. There was a tangible liquid. I mean, why don't you talk about futures trading for a second?
Well, I think it's the most liquid markets that we can trade, and I think that there's central clearing, there's objectivity. I think things are extremely visible. We can liquidate our positions very quickly if we need to. That's comforting, I think, to the clients. I think a lot of the best traders started there, or they gravitated towards these are very, very liquid instruments, and their strategies were worked around very liquid trading instruments. And I think it's no mistake. I mean, you look at some of the most successful traders out there: Paul Jones, Louis Bacon, Monroe Trout.
The list goes on. Paul Jones, Bruce Kovner,
Jim
Simons,
David
David Harding, everybody. Yeah,
they trade a lot of equities. but that's an evolution. I think they started with the futures markets in a lot of cases. So it's a great place to learn. It looks like there's opportunity there to a trader, I think, when they first enter the trading world.
You're a pretty ambitious guy, Toby. We talked about that years back. Give some inspiration to people out there. I think sometimes people think that there's this tried and true method. There's this system that you can follow for life. If you just work for this guy, everything will happen. But as you've talked about in this conversation, it's not that. There's no straight line. There's no do this and you will win. But I think a lot of it, if anyone's listening to you, it's persistence. It's just drive. It's find that passion, find that calling, and stick to it, and know you're going to take body punches. You're going to take gut shots, and it's how you pick yourself up.
Well, yeah, and try not to get hit too hard. Stay in the game so you can learn. The learning process. Look, we're all going to make mistakes. One of the most important things for me is that I was very clear. I needed to learn. I needed to feel that I could develop and get better. So my market IQ could expand and improve, and my understanding of the business could expand, and I could get better at it. It wasn't a static place for me. I think that and that's what has happened. I learned. And I think that we all do that. We have to know that at the beginning we don't have as much. We may be very, 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 very bright people that come to the markets. I can't tell you how many PhDs in the sciences are being hired now by these firms to come in and do research. We do it ourselves. We really look for scientists and people that have great quantitative skills. But without market knowledge, there's they don't really have anything. So that has to be developed, and you have to be able. Mastery doesn't come in a year or two. It's a relatively long process. It seems like maybe a 10-year minimum anyway. If you're going to get to a point, by the way, I mentioned that I don't think I've mastered this quite yet. I still have more work to do.
Hold on, the 25-year track record says something. I'm not sure what, but it says something.
Yeah, it's not bad. But look, I think we're really just that idea of trying to improve. In order to do that, you have to be passionate about what you're doing. You really have to love your work. It is your passion. So without this sort of constant fascination with what the market is, for me in this area, I think it's true in any profession. You find what you love and be thorough about that, and then you master it over time. And I really don't. There are certain limitations that we have on the planet. It's wonderful what we can do as human beings. I mean, we can actually get smarter by building our pool of knowledge, make better decisions through practice. I mean, trading isn't much different than hitting a combination of underspin and topspin backhands. You have to hit thousands of them, and you get better and better at it. That's what we do, and I think that it's sort of the human condition. And finding your passion and then mastering it, I think, is one of the highest levels of what we do, what we humans do on the planet. So it's. I hope that conveys.
No, it does. Listen, I appreciate you taking the time today. I could keep you all day and just keep chit-chatting about all kinds of stuff. I do have one kind of last we could keep talking, but I have one last thing I really kind of would love to touch on. And you've talked a little bit about who you admire and some of mentors, and we talked a little bit about that. I'm curious, though, for people out there, trading, business, philosophy. Clearly, you have a very strong philosophical perspective. What books do you really admire? What have you loved to read over the decades?
Well, if it's about markets, I think you have to look at Jack Schwager's Market Wizard books, I think, gives you a great view of some really great traders. I think that's inspiring stuff. Reading about the highest levels of the profession. I think it's really, really important. It's the inspiration, that's the food you need to go forward. I have to say, Ayn Rand's work, I think, the introduction to the OPAR, I think they call it, or they have a general text on objectivist philosophy that Leonard Peikoff edited and wrote, and it's a wonderful book, and I think it gives a very clear exposition of sort of the laissez-faire approach and the philosophy of objectivism, which I think is so helpful to anybody out there. What other books? Of course, Atlas Shrugged I thought was wonderful.
I'll interject one here as we're along this line of thinking. I'm calling you from Saigon today. So Vietnamese girlfriend, I bought her the other day. She speaks and reads English, but I bought her the Vietnamese version of The Fountainhead, and she went through it faster than lightning. She seemed to really enjoy it.
We have a winner there.
Yeah.
That's great. That's a great book.
If you get through The Fountainhead fast and you love it, I agree, right? Yeah.
Yeah. I would also recommend Victor Hugo's work. It's some of the most beautifully written stuff and inspiring things that I've ever read. So, but at any rate, that's all part of our mastery, is reading as much as we possibly can. It's something it may be a lost art these days, but with all the electronic stuff.
I'll still take a physical book over a Kindle any day of the week. I don't mind searching for something on the Kindle that's great, but I'd rather have I can read faster with a physical book. Everyone can, I would think.
You must be over 40.
Yes. Hey, Toby, listen, it was great chatting. Hopefully we can talk again in the future sometime. I'd love to have you back on. We could, I think people are just going to enjoy this conversation.
Sure. We'll do 10-year checkups if you want.
Well, I'm going to have to bring it lower than 10. We can't do that. It's too long.
I'll be here.
I know you love giving some good philosophical bents, though. So, hey, people can go to check out your firm at Crable.com, correct?
I believe that's right. Crable, something. Crable.
They'll figure it out. They'll figure
it
out.
Something.
Yeah, they'll figure it out.
It's not a solicitation.
No. I'm just informational purposes. So don't send any crazy things to Toby and all that kind of fun stuff. So
buy my next book.
Is one coming?
Yeah, I think I'm working on it. I've got a few years into it now, so it should. The former book will be an appendix in the new book. So because and then it will be updated. But there's a whole storyline on that too. I think I will publish something down the road here. I'm working on it.
Cool. Awesome. Yeah. Hey, Toby, it was good chatting with you again, and I appreciate you taking the time today.
Thanks, Mike. Good
take care.
To you.
See ya. Today in the show, I have Alex Gracerman. He holds the position of Chief Scientist at ISAM, a specialist managed futures fund manager. 25 years of experience in the hedge fund industry. Alex initially began working with Mint Investment Management, the first managed futures advisor to manage more than $1 billion. Mint, started by Larry Hite. Larry Hite of Market Wizards fame. Larry Hite's somebody I consider a friend, a mentor, somebody who has taught me a lot. Great conversation with Alex today. And please check out his new book, Trend Following with Managed Futures. It is the definitive academic treatise on trend following. Alex brings some great color today. I hope you enjoy this conversation.
Are you still in God knows where country?
Oh, I love it. I love it. You know what? Let's just leave it like that. I think that keeps the audience guessing God knows where country. we'll circle back on the back end, maybe if we got some extra time and talk about that. Hey, let me jump right into the heart of the matter. When I had you and Larry on in the spring, I think we were right in the middle of the weekly parade of 26-year-old Financial Times reporters writing about trend following is dead. And then something funny happened along the way to the parade this summer. Even in a zero interest rate environment, in a relatively low volatility environment, all of a sudden you and your peers have started to make quite a bit of trend following money. And I know we don't want this to sound like an infomercial, but I think it's educational in the sense that a lot of people probably don't know that when you see all these epitaphs and obituaries written about trend following, well, it just hasn't worked out that way, has it, Alex?
I've been around long enough to probably seen 4 or 5 of these obituaries written, maybe even more over the years, and we're still here. Last 3-4 months, things in trend following space are pretty good, but this is the nature. We've seen this in our 800-year study, right? This is not some voodoo sort of arbitrage strategy that extracts something from somewhere that, that's not understood, where it could just easily end. This is a strategy that harvests natural occurrings in markets. And, the only way you can, I guess, permanently kill a trend following strategy is to declare all markets to go sideways forever, or to declare that no market will ever move significantly away from some sort of equilibrium. And it just doesn't happen for long enough periods of time. And things move more than, as I'm sitting here, I'm looking at the yield of the 10-year note, and, all prognosticators would have said that, that can't go to where it is now. And here it is, but that's the nature of trend following.
Yeah, look at something like crude oil. I mean, there's been all kinds of fundamental opinions about why oil has to go up or why it's at the right price and this and that. And then, wham, bam, thank you, ma'am. The price is dropping pretty significantly, isn't it?
Yeah, nobody knows where it's going to go, but it's just in nature of people to figure, okay, things are just not going to move far away from where they are. Yet the same people will invest most of their money in stocks and hope that they'll go up 100%. This is why this kind of strategy adds value over time. For example, we're sitting here now, October 14th, just in recent days, the equity markets have made, not major collapses, but material downturn, and things are okay in the trend following space. We're actually making money. So that's, at the end of the day, the value of this kind of strategy.
And I think it's important for people to realize you're not saying that you know what's going to happen tomorrow. You're not saying that stocks are going to continue to go down. But I think what we're going to try and point out in this conversation is there's another way to think except being only long stocks. There's something else out there, and you've been in the middle of that something else for a long time. And before we break apart some of the bigger picture issues in your new book, Trend Following with Managed Futures, I would love for you to go back in time a little bit. And I know you're not a big fan of any kind of personal stories and stuff like that. I know your personality a little, kind of just a facts guy, and I love that. And your book definitely puts that forth out there. But, you work with one of the most colorful people that I've ever met. I would love for you to talk about your first meeting, how old you were, your background, and your first meeting with Larry Hite and how you guys have come to have this great career together. It's really a fun story. And then we'll get into the book and get into some of the meatier issues. But I think the audience would love to hear that story.
Yeah, it was kind of a fork in the road that, as I look back, the joke, if you get to a fork in the road, you take it. I came to interview with Larry in 1989. I was just a kid out of school. I didn't know anything about trend following, or certainly not managed futures or details. I just needed a job. I think I was making $28,000 a year, and Larry offered me $32,000. I still have the offer sheet.
Hold on. You say just out of school. Were you 22, 26, grad school, undergrad?
21, 22.
Okay, young guy.
Yeah. Didn't really know who Larry Hite was, but this was in Milburn, New Jersey, and he was one of the guys that interviewed me. That the really interesting thing is that the Market Wizard's book had either just come out or was coming out. I don't recall whether there was the actual book on the shelf or a draft of the book on the shelf, but somebody gave me in the office the chapter about Larry to read while I was kind of like waiting. And I remember just flipping to, I'm paraphrasing Jack Schwager's question, something like, what's your edge? Or something like that. And as somewhat of a scientist out of school, I would normally have expected some quite scientific answer, because I kind of heard that meant that something quantitative. So some sort of rocket science answer for what people did in 1989. But then I read this psychology stuff about how we know what we don't know. And I was like, you got to be kidding me. What am I doing here?
That was a line from Larry.
Yeah, Larry said that his edge is he knows what he doesn't know.
And you're reading this before you go into the interview.
Yeah, I'm reading this before I'm going into the interview. Interview was kind of like, okay, whatever, go home. But then, like typically you have to follow up and write a letter or an email. It was a great interview, or tell the headhunter that I really want this job. And I couldn't figure out whether I really wanted to tell him that I really wanted this job, because actually I was confused. But, this is actually, now that I see now, no different than the initial confusion Larry gives. He gave a talk in my class at Columbia last week. I teach a class at Columbia. He gave a talk to a bunch of grad students, and he confused the hell out of them too. Because it takes time to sink in.
He makes those simple statements, but the depth of those simple statements is not to be underestimated.
Yeah, it's, later on I've obviously learned what all that means. It's the respect for risk and not getting very emotionally attached to any one strategy and those kind of things, which allow you to survive for decades and decades in the markets. But initially, just like last week in my class, I have 80, 90 graduate school PhD students, and here comes the market wizard, and they start asking him things that they think a market wizard should know, like where gold is going next week or which way the market is going, because he's some sort of a wizard. And he, of course, says he has no idea. He just needs to know what he doesn't know, and if he gets into a trade and if he's wrong, then he has to get out of it. But it is so powerful, but yet so simple. So to go back to my story, really, it's the fact that he offered me a couple $1,000 more that I ended up taking the job. But I really had no idea, no way to appreciate that, and no idea how to judge it really meant or what Larry did. I just I dove in. That's
How quickly did you know, once you were hired and you got into the office and you were around Larry, how quickly did you know this was going to possibly be your passion for the rest of your career? How quickly did you start to have that feeling?
It probably still took a couple of years. I saw the systems making money, but it took a couple of years to kind of sink in what this is about. I was like most probably geeks in the beginning and just trying to find the Holy Grail. But it's, your realization that no matter how smart you are, I see this with all my students, I joke that I try to bring their IQ down after they take my class rather than go up. Obviously, their IQ is high to begin with, but the kind of investment IQ, if you think you know everything, you'll just end up failing. So it took a while to establish kind of like the right mental equilibrium. This is, by the way, where it's hard to hire the right people in this kind of area, because you need a combination of two things that almost never go together, which is very, very smart people that are also very, very humble. And so you have to survive in this business. I think you need to have the right balance. If you get too smart and not humble enough, you get too emotionally attached. There's lots of people out there in the world who are very humble, but maybe not smart enough to do at least the basic arithmetic of the strategies. So, it took me actually a while to sink in, but I've been in this for 25 years. I learned not to get too emotionally attached to, people declaring trend following dead and any of those kinds of things. But, on the other hand, not to feel like we're walking on water when we're up 30% on the year. These things come and go, but over time it works. But Mike, I wanted to make one point about trend following that I think is confusing to people. They focus too much on, the S&P or that market, obviously, because it's in everybody's portfolios. But they think, okay, the value of trend following is just kind of like to time the short side of the S&P or get them out of the long only. I have a lot of allocators who are asking me, well, what's my position in the S&P? And if I say I'm long because trend following is long, then they say, oh, but that's not a diversifying investment. Why do I need trend following? And if I say I'm short, then they say, okay, maybe that's too late. And they try to overthink this. The value of trend following is not just getting the right side of the S&P trade. It may or may not happen. The truth is that the systems are not that great in any one market. The value of trend following is that we can do this over 150 markets or however many markets one can find and really have a diversified, uncorrelated investment. I mean, that's what this is about. That's why it's worked, in our book for 800 years. If you look back at my first experience with equity market kind of shocks, it was in 1987. Mint made 60% in that year. This was, before I started at Mint, so this is in history books. But didn't make that from necessarily timing was it Black Monday, October, or was it 19th or something crash? It made its money in some corn trades and other things and other markets, and same thing in 01, 02, same thing in 2008. The value of trend following, it's not a one market thing. It's a harvesting of natural human behavior in 150 different markets.
Alex, let me interject there. I think there's been, and I'm curious your opinion on this, there's been quite a few, you see papers about trend following, the classical CTA diversified across markets like you're talking about. I think also in the last bunch of years, there's been a lot of papers about momentum, and they specifically focus only on equities. So I think there's some confusion comes from some of the academic work where it's been attempting to attach momentum only to an equity perspective and ignoring what you're talking about as this great diversification.
Yeah, so maybe this is a slightly nerdy for the audience, but there is a difference between so-called cross-sectional momentum, which is almost what all academic papers hit when the equities. This would be some kind of relative one stock to another, and more of the time series kind of momentum, which is what trend following is. We just trend follow any given market, whether it's going up and down, really unrelated to other markets. It's related in terms of the correlation and how much you risk, but not in terms of the signal. We can have no position in all markets except for one. All these equity papers are dealing with this cross-sectional momentum where you compare one stock to another and things like that, and they get into the efficient markets and whether it should exist or doesn't exist. It's just overcomplicating things. When we have 800 years of data and not simple strategies, but simple concepts. You buy high and you sell higher, and you short when it's going down and you cover lower. That works. In fact, one of the academic papers out there called by one of our competitors actually calls it time series momentum. That's what this is. By the way, anything in equities is invariably probably going to correlate to equities, even if you try to make it uncorrelated to equities. What adds value is trend following, whether it's bonds or commodities or emissions or iron ore or obviously currencies, all these other markets. And then people ask me, well, what about the interventions and the government this and the government that? And meanwhile, look where the bond yields are and how far they've gone. Things can go quite far.
The subtitle of your book, the phrase crisis alpha, is in the subtitle. So it's clear that anybody that looks at the data, that during these crises periods, that trend following, the type of trend following that we're talking about, this time series, does perform exceptionally well. There's no guarantee that things will work out that way, but it's performed that way. But what's interesting about this summer, the last bunch of months, we really weren't at a crisis period,
but there still was trend following performance coming out, as I mentioned at the beginning of this podcast, from kind of a fairly low volatility, zero interest rate environment. So it's not, if somebody was to couch trend following as only crisis alpha, that would be a mistake, would it not be?
Yes. In fact, some people in our space have tried to make some kind of an excuse for some lackluster performance by calling this a tail hedge and saying, well, there was no tail. That's a total mistake. Trend following has, two great features that you probably can't find in almost any other investment. First, it's totally uncorrelated. So if you start with that, you look at the history of trend following for 10 years, 20 years, 800 years, it generates a return stream with zero to slightly negative correlation to all other asset classes. So if we take that as given, that's just, when you have 800 years of data, I mean, it's pretty close to given. It's a totally uncorrelated. It also happens to be quite negatively correlated in many periods when you want the negative correlation, which is the crisis periods, because it tends to make money from whether it's inflation shocks or downturns in equities or something else going on somewhere. Typically volatility picks up during those periods and it makes money somewhere. But it's not only that. You could take out all the crisis alpha periods or all the crisis periods, and it's still a great investment. I'd argue it's a liquid investment because we trade liquid markets. And so, people will go in their 401k plan and have 5,000 versions of the same thing, right? Small cap, mid cap, SMID cap. I heard this term recently, SMID cap, small to mid cap, or, large cap and international and this and that. And I mean, how many versions are there of being long only, which are all, call it 80, 90% correlated, 70% correlated at least? Of course, you get a little diversification from that, so fair enough. But imagine in that same 401k plan or whatever list of instruments, now there was something, called XYZ. It wasn't labeled trend following, and somebody remembers, oh, I read something bad about trend following. It's just another investment, another mutual fund or another fund that somebody can put their money into. And you look at it and say, wow, this thing is just different. And it tends to work when other things don't. Well, how much closer do you get to a holy grail? I don't, maybe that's too strong of a statement, but in terms of the possibilities of what one can invest in, how much better can it be? It's totally diversifying, and there's a good chance, no guarantee, but there's a good chance that it'll perform in the periods when other things don't. So, you go back to optimization 101, any kind of optimization of the portfolio should tell you to have some allocation to that thing. In fact, we're writing a paper right now on the topic of how costly is it to not have trend following in your portfolio. How much do you give up by actually not having it? Not in any particular year, but over time. And it's quite costly because you're actually avoiding a tremendously diversifying asset class.
Alex, let me jump into the idea of benchmarking, and specifically those institutional managers out there that really are fixated on stocks, and they look at the world through the prism of stocks, the long-only prism. And your firm has to deal with that. It's a constant education process. And if you look at a situation like CalPERS, they had a very small percentage, relatively speaking, with perhaps managers like ISAM. I'm not sure if they had it. I'm not saying that, I don't know if they had an investment with ISAM or not, but I'm just saying in general, a trend following. And it might have even been too small to even make a difference. How in the world, that's not the best way to say it, but how can a firm like your firm, how someone like me is trying to spread these messages to get these institutional players that control so many assets in the long-only space, and they're only worried about their career risk, frankly, to make the smart decision, to make the wise decision. I wonder if you could maybe relay a story or how you talk to people, watching people convert or watching people not convert to this way of thinking. I know it's kind of a big question, but I'm sure you see where I'm going.
Yeah, I mean, we do this all day long. And some people, I mean, we have major pension fund investors, so some people get it. It's interesting that in some parts of the world, maybe it's Australia, Canada, Middle East. I'm just kind of maybe part of the world that you're in, Japan kind of area, historically have been kind of diversification friendly. It's almost like sort of a mental mindset, maybe because, well, the Japanese market certainly hasn't been going up in a straight line, right? Mm. They have a lot of currency kind of movements, and those parts of the world are just friendly to the concept of diversification, right? Trend following will follow from there, but you first have to have the concept of moving somebody away from 100% equities, right? The U.S. is somehow just this, emotionally attached to this idea that, everything just will go up forever. Obviously, some institutions have allocations to this. The CalPERS thing, by the way, probably was not a managed futures issue. It was just the size of the hedge funds. They actually had a decent allocation to managed futures. But anyway, some institutions it really depends on their appetite for embracing diversification, and as you use the word benchmark, whether some form of diversification is in the benchmark. So, I mean, we look at this, what's the benchmark of the institution? And if the benchmark doesn't allow for this kind of diversification, then we can talk to them till the cows come home. They probably won't risk their career by putting it in. Because at the end of the day, a 1% allocation to trend following is not going to make any difference. It has to be 5, 10, and we have institutions who have investments with us or with some of our peers at that level, but their investment committee has embraced that in terms of their benchmark, and they've just in general embraced the concept of diversification. To some people, it's like so obvious, like, well, I can't believe that we even considered not doing it. And to some people, it's just like, okay, stocks go up forever, so why do I need to bother?
I sometimes think that it would take a Japanese style stock market, perhaps, to really get some people to say we have to change. I think as long as there's going to be some people out there that as long as equities go up seemingly in a straight line, even though there's been some 50% drawdowns the last 15 years, they're going to be hard to convince, aren't they?
Yeah, and U.S., I mean, the NASDAQ is in a, 15, 16, 17-year drawdown, but it's just this, especially in the U.S., like no matter what, it's just all about equities go straight up, equities go straight up, equities will go straight up. I don't know if it'll take a Japanese type of downturn, but some sort of a shock in the system. But again, I'm trying to tell people it's not that you just have to have that shock. Just imagine I call this, a regular mutual fund. Why not have a diversifying, uncorrelated investment in your portfolio that can do well when other things don't? You don't have to appeal to somebody's sense that, wow, this is only going to make money if you go down 100%. People try to overthink the environmental factors for trend following, and then they try to time them. Like some people just got into their heads that this only works when the volatility is high. Well, you said a minute ago that, the volatility hasn't been particularly high recently, and we've done well. There's no law that says a market cannot go. There's no law that says crude oil can't go from, 100 something down to, where is it now, 85 or something like that, in a fairly smooth line. You don't have to have massive volatility. There was a stomach virus affected lean hogs earlier this year and made prices go way up, and not particularly with tremendous volatility. It was just a fundamental event. This whole down movement in interest rates over the years hasn't been particularly highly volatile. So people think, somebody said to me, this strategy only works in high volatility environments, so I'll wait till there's a high volatility environment. Well, things are not that easy, right? By the time you get to a high volatility environment, or it doesn't work because, you have too much intervention. Well, wait a second. The intervention has caused the biggest trend of all time in fixed income.
So they want to trade your trend following strategy, huh? That they want to trade you.
Yeah, they want to trade me. People years ago used to want to time equity markets too. Remember that? People would try to time equity markets, get in and out, fund timing, all this. It's not that simple. It's not supposed to be that simple. What you're supposed to do is have a handful of diversifying investments, and that's what's going to take your portfolio to the promised land, not trying to time. In fact, the worst thing you can do, I tell people that the worst thing you can do is to trend follower, right? To try to time it that when they're doing well, I should give them more money, and when they're doing poorly, I should take money away. That is actually the worst kind of investment you can make.
Let me shift gears on you again. I think you're fairly clear on your opinion there. The science of trend following. So we talk in the beginning of this conversation, you meeting Larry, you talk about being a teacher. You have many, many PhD candidate students at Columbia. So let's say hypothetically, so you're the top guy now, or one of the top guys now. So they come to the office, the new employee comes to the office. Obviously, in this day and age, they're going to know something about ISM. They're going to know something about you. They're going to know something about Larry before they sit down with you. But you have to introduce the science of trend following to that new candidate, that new person that you want to join your team. How do you start? I know this can go on for a long time. There's no way we can even break apart your book, the density of your book. As I told Katie, I said, you guys have put down the academic treatise that I don't know who's going to attempt to compete with. But how do you introduce to that new person in your office the science of trend following? Science and investing. This has been a relatively new phenomena that people connect these words together.
In the book, we have all these things like adaptive markets hypothesis and behavioral theory and things like that. But at the end of the day, what I would tell people is that the markets are some sort of a risk transfer mechanism. You cannot assume that just because you're smart, you will suck money out of the markets, right? If you think of it like a poker game, it could be a zero-sum game. You could be the best player, but then your profits will come down, not because your skill goes down, but because the other people at the table will just leave the game. So is it a game of zero-sum kind of outsmarting people, or is it a natural phenomenon in the markets, almost kind of like providing insurance? Larry talks about this in our last talk about relating trend following to insurance. So I just say that, okay, there are natural occurring things in the markets. Let's start with something other than trend following, so we have an analogy. Value investing, right? It's been scientifically, dare I say, proven or shown with data that value investing works because a lot of investors don't want to hold those stocks when they go down, and you actually earn a economic rent type of risk premium if you hold them. There are other examples in the markets where you're actually providing value to the markets by doing a certain thing. That's what makes it lasting, right? Because there's no way for 800 years you could find some gimmick that makes money where you would only do that if nobody else knew about it. There's no way you can get away with that for 800 years, right? Somebody from my class will figure it out and it'll be gone. This happens a lot with some, high frequency and those things like that. So the science is, the natural element of it is that what we're actually doing, what trend following is actually doing, is providing liquidity to the hedgers, and it's creating an equilibrium in the markets, and we have to get paid for that. That's why this works for 800 years. If the price of oil, for example, is going up, right now it's going down, but if it's going up, airline companies will almost certainly need to sell oil to lock in a future price, right? They're not in the business of counter trending. They just need to sell it to lock in a future price. We at that point buy it. Maybe it gets us a little technical, but just it's conceptually establishing the fact that it's a natural occurring thing. The markets need players like us. Otherwise, you just have a whole bunch of hedgers that, just the markets won't exist.
You haven't used the word speculation. You're speculators.
Yeah, we're speculators. And then, actually we're talking in the book, there's hedger, speculator, risk transfer, and you need to have this. But it cannot be, if you think about kind of evolutionary things, it cannot be a free lunch. If I made money in every single trend following trade, the hedgers would stop hedging. Sometimes their hedge turns out to be a good idea. Sometimes they would have turned out better not to have hedged. Sometimes, I will look better if I bought oil, or I look better if I somehow ignored that trade. Of course, we take all trend following trades, but it's supposed to be slightly painful. But, in the end, if you look at the 800 years, the data shows that the equilibrium risk adjusted returns are pretty good. They're slightly painful. That's why you can have a couple bad years, or you can have drawdowns. If it was too good, you would have every hedger hiring a quant from my class and run, moving average systems to time their hedges. But it's the equilibrium of the markets that establishes this principle, and that's what makes it work over 800 years. But trend following is almost unique in that area. I know you talked to Katie about divergent and convergent. A lot of convergent type strategies are very limited in their capacity, very limited in what they can do, because if 5 other people discover it, it could be gone. This is just a natural thing. You called it hedger speculator. So I think that's a good answer. That's how I start with, in fact, I just hired somebody from my class that started working with me. That's how we described it. It's a naturally occurring phenomenon in the markets. Then it's just a matter of a handful of different ways of actually capturing it. But it's there. It almost cannot go away. It can temporarily, on a mark-to-market basis, not work. But it just structurally cannot disappear. Otherwise, you might as well shut down the markets and go back to communism.
Well, hey, that's a great lead in to where I wanted to go. I have a few big picture trend following type questions left, but since you had told me, and I knew by your accent, you were born in the former Soviet Union. What country were you born in, Alex?
Well, actually, I don't know. No, it's I've had my passport changed several times. My U.S. passport originally used to say USSR because I came to the U.S. when the USSR still existed. So technically, I was born in the former Soviet Union. But then they called me up and they said, okay, we need to change your passport because this new country got created called Ukraine. And now we have to reprint your passport, and now it says born in Ukraine. But now with what's going on there, right? I mean, they might call me tomorrow and say, okay, we have to reprint your passport. Now you were born in, I don't know, Russia or something else.
Here's where I wanted to go with, though. Bringing it up, though, is not just for a kind of a silly reason or a flippant reason. So do you feel like, though, in your career, I don't know, what age did you come to America?
12.
Do you feel like you've had, I just relay a personal, nice achievement in your life, nice successful career. I think a lot of people would say, gosh, I wish I knew how to make those steps. Did you have an advantage coming from where you came? Was there a built-in drive or motivation that you think gave you an advantage over other peers that you might have seen in America once you got to America?
Well, I guess I know we probably don't have hours to speak about the immigrant drive, but right, that's the immigrant drive that got me to, I don't know, maybe going on interviews in an area that I had no clue about because I could maybe make more money. I mean, at that point, it was like sort of survival and making money kind of thing, not this grand idea I'm going to become a finance, person. So it's just the, bouncing around from washing dishes to Friendlies, which was my first job, to this and that to pay for school. Certainly my parents didn't have money to really, pay for anything back then. So it's just like the inherent immigrant drive to keep pushing. I had a job before I went to interview for Larry, but I wanted to do better. I don't know if there was any other advantage other than just keep pushing, keep driving, don't assume somebody's going to hand it to you. Larry, probably you've heard stories from him. He had a disadvantage with not being able to see and those kinds of things. I had a small disadvantage in the beginning. I couldn't even speak English. So that's why I had a dishwashing job. Nobody had to tell me what to do. If there's a pile of dishes, then I had to wash them.
Meeting Larry was an opportunistic type thing, because let's face it. I mean, I know from when I first met Larry, I mean, he gave me so much of his time and energy, and we met so many times. And I just feel like, Larry's the type of guy that if he sees somebody trying and really pushing, Larry's the kind of guy that reaches down and says, okay, I'll give you my time. If you're really hungry, I'll give you my time. And, I feel very fortunate to have met Larry. Have not spent as much time around him as you, of course, but still, it's changed my life to meet people like Larry.
I started at Mint not as some kind of a massive. I started as a technical guy doing some Sybase programming. I was kind of like quite a low level person. Could have stayed as a technologist for any number of years, but again, it's that drive to see what else. I mean, I moved into hung close to Larry, got to know about all these know what you don't know and what he means, and kept asking him about it, and that's how I moved up. So I grabbed my opportunities. But again, that's not a Russian thing per se. It's just I call it the immigrant, the immigrant drive. I got to go get it. Otherwise it's not gonna come to me.
Well, my great-grandfather came from Lithuania in the early 1900s, and they were in coal mines in Scranton, and his kids became doctors and engineers. So it happens quick when they got the drive, huh?
But I was really, at the end of the day, when I look back, just trend following. Washing dishes obviously wasn't going to make me money, so I had to cut the loss there, right? I did work for 1 year out of school in an engineering role. I worked for RCA on high definition television because I had a degree in electrical engineering. It was not losing me money per se, so it's not technically a losing trade, but it was just not going to take me anywhere, so I had to cut my quote-unquote losses there. So, I just trend followed my way into this. Trend following is just a good general philosophy of life, right? It's not just on markets. I mean, it's how people live anyway. This is why trend following in the markets works, because that's how people are.
I want to talk about getting some meatier issues. So when people look at trend following performance across the many managers out there, and we don't have to name names, people can go look at the performance. It's all freely available. I know often I can see up and down months where you can see, okay, trend following traders had a good month. You might see double the return for one particular trader versus another, but still, it's pretty easy to see that there's dispersion amongst trend following CTAs, trend following managers. Why don't you talk about the idea of that dispersion?
Yeah, it's by analogy to equities, it's actually very simple. Initially, this is complicated. This is why, actually, a reason why a lot of sophisticated investors, like the institutions you asked me about, have a hard time getting in, because they feel like they might make dumb decisions about the space and end up picking the so-called wrong manager, the wrong trend follower, because they have no understanding of what causes differences in performance, and they get a little emotional. What makes one manager better than the other? Well, is it who made more money last year? Does that make them better? So they don't know how to step in. But actually, if you, just need to read 1 or 2 chapters in the book, it's actually not that complicated if you just make yourself aware there's a couple factors that drive performance. For example, in the late 90s in equities, by analogy to equities, the late 90s, so this is where, every internet stock went up 100% every day, and every brick and mortar stock stayed flat or went down, right? So you had this so-called dispersion between value and growth. Most investors understand that. That's why they'll have both in the portfolio. Sometimes you have dispersion between small cap and large cap. So if you make just a few, let's call them sub-classifications. So it's not just, okay, trend follower 1, trend follower 2, trend follower 3. Okay, those are the trend followers, but they have a particular focus. So if this was equity manager 1, 2, 3, the first one might have been growth focused, the second one might be value focused, the third might be small cap, fourth might be large cap. There's going to be some correlation between them because those guys are in the stock market, but there's going to be some fair degree of dispersion. And in a year like 1999 could have been 100% degree in dispersion. So now investors in long only say, okay, I go to my Morningstar little matrix and then I need a little bit of value, a little bit of growth, so I kind of diversify. Same thing in the trend following space. You just kind of do a little bit of analysis and say, for example, the words are not the same. So it's not value growth. It's, for example, we introduce certain factors in the book like the speed of trading. So you could do trend following quite slow because either by choice or if you manage lots of money, maybe you have to be a little bit slower because of the size of your assets, or you can be a little bit faster. And you can get some different results and you can attribute them to the speed of trading. Okay. You can also have a market mix kind of bias. You could trade only kind of like the large markets, again, either by choice or because you're big, or you can be quite a bit more diversified. Like, for example, we are trading a lot of smaller markets. Well, sometimes those will cause performance differences. And so really, if you just track a few of these things, if you have to pick one trend follower, like the one, okay, you have to, I guess, interview them all and somehow pick the one. But if you would like to have a portfolio of 2 or 3 in kind of a diversified portfolio of trend followers, it's not that hard. Just look at a couple of these factors and who's tilted to slow and who's tilted to fast and these kinds of things. And you think that helps the audience is just by analogy to like the whole value growth thing. Just a little bit of effort, and then that can explain quite a bit of the dispersion between the managers. It's not just sort of random because people are sometimes afraid, well, wait, you have 8 guys doing the same thing and you have like this massive difference in performance. I don't know, what is it? Some guy has a faster machine or bigger computers and like they get scared because, whoa, they picked the wrong one. What is it? It's not that. They're doing conceptually the same thing, but they have certain portfolio tilts that can cause these differences. And with just a little bit of effort, one can understand them.
And speaking of a little bit of effort, and this is not a plug necessarily, but if people want to dig into even more of where you are going with all these issues, they're really going to have to pick up your book. And like I said, it's not a plug. I mean, for relatively speaking, for the price of admission, you just don't get that combination of words. I mean, as a guy who's done some work in this arena, what you guys put together is substantial, to say the least. One last question, Alex. It's all the rage in the conversations, the media, Fed watching, discussion for the last bunch of months, rate hikes, interest rates going up. Now, I'm curious because my first thought would be, and I think this has got some truth to it, we don't necessarily know what's going to happen if there's going to be a higher rate environment. We don't necessarily know how that's going to affect trend following. Give me your opinion. What's your thought process there?
We've looked at it over the 800-year data set, what happens in rising interest rate environments. But let's ask this question. You think equities might do well in that environment? I'm no prognosticator, but maybe it's possible that they won't, right? Will bonds do well in that environment? Well, almost certainly not, right? Because rates go up, then like bonds have to go down. So I would put trend following as maybe one of the few things that might do well. But let's talk about this for a few seconds, right? Trend followers are agnostic to the direction. So if yields go up, so the prices go down, we will be short bonds. Now, it hasn't happened for many years that there have been substantial hikes in the markets. But if you look at the data, we have data on interest rates from 1395. Venice issued bonds in 1395 called Venetian bonds. So we have centuries and centuries of data, plenty of rising rates environments. And I'll just simply say we will make money being short bonds if that happens. Now, people ask technical questions. If you short bonds, you short carry, will that hurt you? I mean, the chapter explains on that explains what that is. It's not really going to hurt us. There's going to be almost certainly inflationary pressure somewhere, so we probably make money off commodities. There'll be, some interest we get on cash, as it's a technicality, but most trend followers put up T-bills as margin, so we'll make more money on margin. We'll make more money on something called the roll yield in commodities because we have to roll futures contracts. When you put all this together, it should be pretty good. At least we have a pretty good chance of making money, a better chance of making money in a rising rate environment than a fixed income portfolio, let's put it that way. And meanwhile, look, some macro funds out there, not naming names, have been betting on a rising rate environment for how long? I don't know. Let's say a lot of this year, and they've been losing money on that. So look at the perils of timing. Of course, at some point rates will go up, right? It has to be a truism, maybe in our next life or something, but at some point they have to go up. But look at Japan. I mean, where's a law that says 10-year rates in U.S. can't go down more? I don't know. Meanwhile, we're making quite a bit of money on the trend that's in front of us now. When it turns, there'll be a little bit of pain when it turns, and then we'll make money the other way. This is the perils of timing, because you could sit there frozen like a deer in headlights, avoiding, ignoring what's going on now, not making money out of it, betting on a rate hike. When is it going to happen? I mean, yesterday already the Fed made some announcement, and now the market thinks it's going to happen later. I mean, nobody knows how to time those things, so just let a trend following system time it. And meanwhile, let's take the money, put in our pocket from rates going down. What's wrong with that?
I think what's so fun about this conversation is that it's been very plain talk. I think you've explained these issues just really nice, where people can walk away and say, wow, I wrapped my arms around that in a much better way than perhaps I did before listening. But then if they want to know the depth, getting back to the original idea of when Larry would introduce you to these simple concepts and then you found out the depth, you and Catherine have put that depth in a text. And I'm curious, I don't know if you know off the top of your head, how many words are in your book?
Not sure. It's 400 pages. Now, I would suggest for your readers, first of all, don't try to read front to back, all at once. There is I'm not plugging for Amazon or Wiley, but the Kindle version is, well, A, it's a little cheaper, but B, it's actually in color. So just to let your audience know, it's because the book is, quite thick. It has a lot of graphs and charts. And I noticed the version that's on the internet, on the Kindle in color, online, is in color, and it just might make an easier read. But, it's a lot of words, a lot of topics, but it's actually not that, it's not that complicated. If you skip a few formulas.
It's got a little depth to it, Alex.
Yeah, for people who need it, But again, for a lot of people would just say, look, I can just, and I've had conversations with prospective investors from simple to very, very sophisticated. At the end of the day, if you look at it simply, you just include an investment to this because, like I said, it's uncorrelated and diversifying. If you want to know about the theory of adaptive markets and all that, then, you have that chapter. So far, we have quite good feedback on it. It's not a how-to guide. One thing I'll tell the audience, they read that book, they're not going to have some magic solution that they can start a trend-following fund and compete with us. It's not about that. It's about understanding trend following and being a smarter investor in trend following strategies, understanding things like dispersion and benchmarking and what we talked about. One of the reasons we did this is just to bring some academic rigor to what's actually a fairly large industry. I mean, CTAs have a couple $100 billion, and they've never had this kind of sort of like rigorous evaluation that will help institutions. I think this will get more institutions. We just had a big consultant that put CTAs on the list of approved investments, and they hadn't done it for 100 years. One of the really, 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 really big consultants who consults to really, really big institutions, because of this kind of academic work, allows them now to be a smarter Investor, aha, they know how to benchmark. Aha, they know how to explain differences in performance. So now they can put this in front of investment committees and answer questions about that. Before, it was just a voodoo thing. Here's somebody's track record. Okay, so what? So, little by little, this will get, shelf space, and it'll get into people's portfolios and
intellectual shelf space, because there's no more bookstores out there, unfortunately. So, I've seen them in Singapore, though. The bookstores in Singapore were really, really packed when I was there recently. So it's
a real bookstore.
Yeah. They're packed. I mean, all the current best-selling titles in America. So I don't know if it's going to go by the way.
Well, help me get this book on that list.
Well, I think it's. I don't know anything about Singapore bookstores. I did have a book that appeared on their bestsellers list a few years back, but I'll see if I can dig up some info for you that can perhaps help. Wiley, for one thing, we'll just get on Wiley and say, hey, guys, we want this baby, because they love that kind of detail. I mean, it's the only place in the world where a taxi driver has ever recognized me. And let's face it, I'm not exactly writing about, topics that are, James Altucher or more famous people. I mean, a taxi driver recognizing a guy that writes a book about trend following? Come on. So, yeah, I'd get on Wiley about getting in those Singapore bookshops.
Okay.
That's my pitch. Okay, Alex, people can go to isam.com, and I think there are some papers that that everybody can take a peek at if they go to the site. I
think so, yeah. Or find me through Columbia. We do, as a business, a high degree of education. This is how the book actually came about. We had been writing white papers for a while. We have a white paper coming out actually this week on an interesting topic. Maybe it'll be the first chapter of the next book. So continuing the education. There's a big thing right now, just to ask myself and answer a question quickly. There's a lot of mutual funds forming, sort of liquid alternatives, a lot of so-called cheaper versions of trend following being offered. I want to educate people on, what you get for what you pay for, and be careful about those things. But you will have now you have mutual funds that you can buy that do trend following. So the access points will be easier for people. They just need to be able to evaluate what they're getting. But it's going to become, the train is out of the station. It will become more mainstream.
Let's leave it there, Alex. Great conversation. I appreciate you coming on today. And like I said, everybody can go to Amazon, Trend Following with Managed Futures, Alex Gracerman, Catherine Kaminsky. Easy to find, easy to buy. Hopefully we can talk again in the future, Alex. I'm going to have to get Larry on for a really long conversation too. Alex, it was great talking, and hopefully we can talk again in the future.
Thanks, Mike.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.